Hello, everybody. Hey, this is Mad Flow. I'll be flying solo today. What that means? They may pop in, they may not pop in, which is our other host, Tanya Scott Filcher, and also Anthony Murray. They may pop in, hopefully they will, but we're going to have an exciting show today. This is Mad Flow. Welcome to your show. Again, this is your show. Financial Sins brought to you by All Things Relevant Media. We're going to be here every Friday, starting 1 o'clock until 2 o'clock. This is Mad Flow. Let me tell you a little bit about me. For those who have not heard, I used to be a police officer, retired in 2007. Then I turned out I wanted to do finance, teach people how to understand their money, and teach them the importance of understanding finance, period. Because if you don't understand it, there's no way you can basically prosper and make more money. So you have to understand how that money works for you. Mad Flow, been married for, I forget the years, but it's been a long time. Just because I forget the years does not mean that it's not a good marriage. It is a good marriage. But my husband's name is Arlie Sturdivant, and I am Glover. Never took his name when I was married because, you know why? I love me. But anyway, we got a great show. And we're going to be going over basically business insurance today to get you to understand business and why it is important to have a certain type of business insurance, depending on the size of your business as well. Now, we're going to spice it up just a little bit. And when I'm talking about spicing up, about every 10 minutes, I'm going to come in with a question because I'm going to give 10 people, 10 of our audience, an opportunity to earn this book here, to win this book here, Saving Your Future. In one of our great books that we have, Basic Principles of Building a Financial Foundation. So how are you going to win this? About every 10 minutes, I'm going to ask a question. And how am I going to find out who is the winner of this book? Easy. When you put the answer in the comment section, I think it has a timestamp on it. So when I look at the question and see the timestamp, whoever answers the question first, guess what? They're going to get this book here. Now, what you have to do in order to get this book, you have to do something. If you answer the question correctly, You're going to have to send me your name, your telephone number, your email address, and if you want me to uh, mail it to you, I'm going to need your address. But in the comment section, if you win, just take and put the email address, telephone number, and your name. And then from there, I will give you your book. So about every 10 minutes. And if I forget to ask a question within that 10 minutes time, you just take and send me a chat or something, and then I'll know, hey, it's time to answer that question. Let me tell you a little bit about the company I work with. It's called World Financial Group. But within World Financial Group, there is a division, one of the largest divisions within World Financial Group, called World System Builder. Now, World System Builder, that's where we work. I work right here in Savannah. Our office is right at 5105 Paulson Street. I've been doing this since 2013. Enjoy what I do because I am a financial educator. I actually teach people, about finance. We have workshop classes. Now, the workshop classes, we have these classes Monday through Friday, financial workshops. So if you want to learn more, and I'm always saying this, if you're a parent and you want your children to learn, you cannot teach what you do not know. So if you don't know it, there's no for you to teach your children. So I want you to get in the habit of realizing that financial education should be a part of your family's mentorship. They should be learning about financial education within your family. Now, if you want to register for the classes, this is where you go. worldsystembuilder.com/WSB-US. You go there, you register. Classes are every Monday through Friday, 2 p.m., 8 p.m., and 10 p.m. I think that's very convenient for you to be able to do that. Now, our other host is not here today. They out on the road somewhere. They might pop in, and then again, they might not. But I hope they do have an opportunity to pop in. But let me tell you something. There is nothing that we share on this show that is new information. It's only new to you if this is the first time you heard it. We live in what you call a microwave information world. What does that mean? Just like the air fryer now. You remember you have to bake something for 45 minutes or an hour or whatever. And now you can put it in the air fryer for maybe about 2 to 3 minutes. Boom, it's out there. We live in a microwavable information world. If you want to know anything from finance to cooking to building a house, you can Google it, you can Bing it, you can YouTube it, you can Yahoo it, you can read it in a book, you get audio books, ebooks. There's so many avenues that we can receive information. The power to increase your knowledge is at the tip of your fingers. All you have to do is take the next step and just, get the information because the resources are out there. So what I want to talk about today is 3 topics. One is called key person insurance. So to get you to understand what a key person is, key person insurance. And then another one is something called buy and sell. And then another one that we're going to talk about is going to be executive bonus plan. So let's start with key person insurance. So if you're a business owner, you want to take a look at and understand key business person insurance. But first, I want to let you know something. In this book right here, I think it's like on page 29, it does cover a little bit of information about key person insurance. So really everything that we cover and talk about on this show, majority of the information is in here. And this book comes in so many different languages. It comes in English, it comes in Spanish, comes in Vietnamese, Chinese. We're about to get French in. So it's in so many languages. So what is a key person? Key person insurance is a life insurance policy that a company purchases on the life of an owner or a top executive or another individual considered critical to the business. The company is the beneficiary of the policy and pays the premiums. Now, this type of insurance is also known as key man insurance, but also it's called key women too. So you could be called key women insurance as well. So the key thing here is this. The company pays for the insurance premiums and is the policy's beneficiary should the person die. Okay, so the employer is getting the insurance on their key person, which is their critical person. If something happens to this person, hey, the business could shut down because that was the person that was basically running it. So basically, understanding key person insurance, you find a new person or to implement other strategies to save or shut down the business. So what's going to happen is the death benefit essentially buys the company time to find a new person or to implement other strategies to save or maybe shut down the business, but in a timely manner. So a key person is very critical. Now, the key person could be the owner of the business himself. So in a small business, the key person is usually the owner, the founders, or perhaps a key employee or two. The main qualifying point is whether the person's absence would cause major financial harm to the company. If this is the case, the key person insurance is definitely worth considering. Now, life insurance is usually the vehicle that is used to purchase key person insurance, but it's also available as maybe a disability. So you can get disability coverage just in case the person or individual or the owner is incapacitated and no longer able to work. So now you have what? The disability insurance as well. So you can get the life insurance or you can just go ahead and get the disability. No. Now, how key person insurance works. For key person insurance, a company purchases a life insurance policy on certain employees, pays the premium, and is the beneficiary of the policy, as we've said. Now, in the event of the person's death, the company receives the death benefit. So the company receives the death benefit, whatever that death benefit is, whatever the amount is. It could be 100,000, it could be 200,000. All depends on the size of the company for one thing, on how much the death benefit would be. Now, what could they use that money for? The employer could use that money to cover the cost of recruiting. So they have to recruit more people. Now they have the funds to put that in place. They can use those funds for hiring. They can use that funds for training a replacement for the deceased person. It can also use it to pay off its debts, distribute money to investors so they can use it for that purpose. They can also provide severance benefits to employees. Whatever it takes to basically keep this company afloat, that money can be used for that purpose. To close the business down in an orderly manner, that could be used for this purpose as well. So the key person insurance gives the company some options other than what? Immediate bankruptcy. So don't have to worry about, shutting down or filing bankruptcy. They have the funds that they are able to utilize to keep the company afloat. So key person, you want to think about that. Key person insurance. Do you need, if you have a small company, would it be beneficial for you to use to make sure that your key person has that coverage? Okay, so you want to think about that. Okay, so I want to talk about another. Now, what type you can use? You can use permanent life insurance or term life insurance. Now, permanent life insurance is going to be a little bit more expensive. Term life is a lot cheaper. I won't say a lot cheaper, but it's more economical than a permanent life insurance. So you got choices there. Depending on the company and depending on your situation, you can use term or you can use whole life. So let's think about key person. And what about the cost? Like I said, it depends on the size of the company, because you can get, if you need 100,000, maybe 250,000, maybe 500,000, 750,000, $1 million. It all depends on the size of the company. Okay, so I want you to pay attention to that. And also, when you're looking for key person insurance, you want to definitely take a look at the premium, how much the premium is going to cost you. Okay, so that's something to look into. Now, we talked about that. Now it's time for a question. Okay, so I want to know if you can answer this question. And if you can answer this question, this is yours. So I'm going to give out 10 of these. Here's the question. Spice it up a little bit. So if you know the answer, just you can type it in. If you're the first one to type it in, don't worry. Someone else has the same answer. All we got to look at the timestamp and see who said it first. Okay. This question is this, and all these questions are coming out of our, the companion book, which is called WSB Financial Foundation Education. This is our workbook. This is our workbook, which is the companion to this book. So when we do our workshops, you're going to receive this book and you're going to receive this book. They work together in our workshops. So the questions are going to come from here. First question, see who can get the answer. All right, the question is this. It's very simple. To ensure that my property will go to whom I choose when I die, I can create a simple what? If you know the answer, type it in. It'll be timestamped, and then I'll be able to look at it and see who answered it correctly. So the question is this. To ensure that my property will go to whom I choose when I die, I can create a simple blank. What is the answer? Who's going to win this here today? That's number one. So let's see who's going to win that one. Now let's get back to getting and understand business insurance. Another type of insurance is called buy and sell agreement. Okay, buy and sell agreement. But before we get started, let you know something about key person. Key person is not, they do not get like a deductible or tax credit or anything for a key person insurance. Okay, now let's take a look at buy and sell agreement. What is a buy and sell agreement? A buy and sell agreement is a legally binding contract that stipulates how a partner's share of a business may be reassigned if that partner dies or otherwise leaves the business. Okay. Most often, the buy and sell agreement stipulates that the available share will be sold to the remaining partners or to the partnership. Okay. So let's give some takeaways from here. It's also known as a buyout agreement or business will or even a business prenup. Prenup. You heard of prenup in a marriage? Well, this is a prenup in a business-related partnership with, two or more partners. Now, the giveaways here is this. The buy and sell agreement stipulate how the partner's share of a business may be transferred in the event of the partner's death or departure. So it does not just they don't have to die. They could retire or they could leave the business. But if they're going to leave the business, there's something in place that protects the other partners with the business. The buy and sell agreements may also establish a method for determining the value of a business. Now, the two most common buy and sell agreements are called cross purchase, and then another one is called redemption. Okay, now some agreements will combine the two, but let's just break it down a little bit. Cross purchase agreements allow remaining owners to buy the interest of a deceased or selling owner. Now, the redemption is a little different. Redemption agreements require the business entity to buy the interest of the selling owner. Okay, so one cross purchase is one who is either deceased or they're selling the ownership, and the redemption require the business entity to buy the interest of the selling owner. So buy and sell agreements. So if you're in partnership with someone, you just think about that. If that other person passes away, you know who has rights to that company? The family. Didn't think about that, did you? So you'll be able to buy their part out with a buy-sell. Now, how does it work? A buy and sell agreements are commonly used by sole proprietorships, partnerships, and closed corporations in an attempt to smooth transitions in ownership when each partner dies or they retire or decides to exit the business. Okay. Understanding the buy and sell, like I said, there's two types: the cross purchase and a redemption. Now, in order to ensure that funds are available, partners in business commonly purchase life insurance policies on the other partners. In the event of a death, the proceeds from the policy will be used towards the purchase of the deceased business interest. Because you think about it, if you're in partnership, you have someone else who's in partnership with you with this business, that person passes away. His part of his business, you know what? It becomes, it's his estate. So if you have this in place where you'll be able to buy him out, then you'll be covered. So you just think about that. Do you want the wife of that person to come in, or the husband of that person to come in and basically try to take over? When you have this in place, all you have to do is buy them out, and then it's covered. So partners should work with both an attorney and a certified public accountant when crafting a buy and sell agreement. So make sure that you are, you've got the right people in place who are helping you along with this and can help you understand how to go through the process of a buy and sell agreement. Okay, very simple. Now, buy and sell agreements are designed to help partners manage potentially difficult situations in ways that protect the business and their own personal and family interests. For example, the agreement can restrict owners from selling their interests to outside investors without approval from the remaining owners. Okay. Now, a typical agreement might stipulate that a deceased partner's interest be sold back to the business or remaining partners or owners. This prevents the estate from selling the interest to an outsider. Just like I stated before, it becomes part of their estate. They pass away, it becomes part of their estate. So that family, they could potentially sell his share of that ownership of that business to an outside investor. So if that happens, now you're in a sticky situation where you have, these people trying to come in, they want to do what they want to do. But so just consider buy and sell and understand how that works. Okay. So in addition to controlling ownership of the business, buy and sell agreements spell out the means to be used in assessing the value of a partner's share. This can have uses outside the question of buying and selling shares. For example, if there's a dispute among owners about the value of the company or of a partner's interest, the valuation methods included in the buy and sell agreement would be used. Basically, the valuation of the what the company is valued at, they will use that instead of someone's trying to stipulate how much the company cost or what the value of the company is. Already stipulated in buy and sell, and you know exactly how much you're selling it for. Okay, understand that. Question time for this one. All right, question time. And these are so simple because since we've been on this show, the questions that I'm asking have already basically been covered. So you should be able to answer these questions. Next question is this. To avoid the probate process, I can consider a what? To avoid the probate process, I can consider what? Getting a what? Completing a what? So answer that question there. Whoever answers that question is going to get one of these. All right. So now let's go to the executive bonus. Now, those other two that we talked about, there's no tax exemptions on those at all. So you don't get any kind of tax credit, okay? But the next one that we're going to discuss, which is called the executive bonus plan. Now, there the employers can actually get a tax credit. So this is something an IRS called the 162. Section 162 of the Internal Revenue Code is the section that states that employer may deduct certain expenses, including salary and other compensation that are ordinary and necessary business expenses. Okay, so this is also called the Section 162 plans because it is an IRS code, non-qualified plan. Non-qualified basically means that executive bonus, everyone in that company do not have to get an executive bonus. Like if you do group insurance, a certain amount of people have to offer it to a large amount of the employees full time. Okay, but with executive bonus, the employer gets to choose specific people or a group of people. Okay, in its simplest form, an executive bonus plan is one in which an employer pays the premiums on a permanent life insurance policy owned by an employee. So the employee owns it, okay, but the employer pays for the premium. So that's why they call it a bonus, executive bonus. And the employee gets to choose the beneficiary. So employers often seek additional incentives to motivate their executives. And this is one vehicle that they can use to basically give an incentive for the work that they're doing, if they're very valuable employees and they want to make sure they can keep these people. They don't want to be, leaving them and going somewhere. Give them an executive bonus. Okay. Now, as a non-qualified plan, because these are non-qualified, the executive bonus plan may simply be used by the employer to provide special treatment to a key executive in compensation for his or her contribution to the success of the company. Okay. Now, the employee's bonus is an executive bonus plan is accounted for as salary to the executive. So that's the salary to the employee. As such, it is deductible to the employer within the limits of reasonable compensation, okay, and taxable to the executive. So the executive, they will be taxed on this. And it's important to keep in mind that the premium payment made by the employer is deductible only because it is compensation, not because it is a non-qualified plan contribution. Okay, so they do get deductible, but only because it's a compensation. They're compensating the employee for his outstanding work by giving him executive bonus. Okay, now the goals are this with an executive plan. It can be achieved within the period being measured. So what if you want to give your executive bonus to the employee, to your executive? If he's doing a great job, 1 year, he get that bonus. But then all of a sudden he slacks off. If you want, you can discontinue that bonus. But most people are going to continue the good work, so they continue to get that bonus. It calls the executive to stretch his or her talents and are under the control of the executive. So the executive controls the plan. They get to choose their beneficiary. Okay, so if they're married, they can choose their spouse, or if they not married, if they want to leave their children, their best friend, or whatever. So that's a great thing right there. So executive bonus. Okay, another thing we know about executive bonus is this. Now, how do they? Most big companies are using executive bonus. Okay, it's going to be a big company, really, truly. Small companies usually don't do this. They'll do the buy to sell, or they do the key person. But when they have a big company, they utilize this. But adjustments to management compensation are major expenditures. For that reason, establishing an executive bonus plan should be preceded by a resolution from the board of directors authorizing this. So that basically means that a head honcho in the company cannot arbitrarily just open up this plan for one of their people. It still has to go through the process of going through the board of directors, which is a good thing. Okay. So to authorize the plan, the board should pass a written authorization that will identify the plan participants by name. It should clearly state the bonus is additional compensation that will purchase individual permanent life insurance and identify each participant as a member of a select group of corporate managers. Now, realize that this one is using permanent life insurance. They don't use term life insurance. Why permanent life insurance? Reason being is this: term life insurance is not a permanent, it does not grow cash value. A permanent life insurance, it builds cash value. So now the cash value that is grown within that plan, guess what? The executive, they can use that cash value as it grows as another source of retirement for their retirement. Think of this right here. Okay. So let's say that you are an executive and you're granted an executive bonus. It's a life insurance, permanent life insurance. Now, if it's a universal life plan, and most of them are going to be that means that more money can be put into the plan over the premium. As that policy grows cash value, let's say that you was getting your executive bonus for 20 years out of your 21 years of working at that company. And in 20 years, that cash value has grown to $300,000. Now, guess what? You have a death benefit. If something happens to you, your family would be covered. But also now you have a second form of retirement. So now you can start utilizing that money, $300,000, on top of your pension that you're already getting or whatever from the company. Now you can start utilizing that. You start pulling money out of that and have yourself a retirement plan. Okay. So that's the great thing about an executive bonus. Big companies use these as an incentive to keep their top people, don't have them going over somewhere else. It's probably giving an executive bonus and they're not. So it's a way that the company can kind of don't want to use the word guarantee, but it kinds of give them the security that they will have that person for a long time. So those are the three types of life insurance that basically can be used for your business if you own a business. Okay. Now the information, like I said, this is what you call a microwave era. Everything, we want it fast, but the information I just covered, you do have that in this book here. It gives just a short synopsis. It's not very long, but this book here, Saving Your Future, is chock full of information, financial information. And I just want to go, time for a question. Okay, the next question. Okay, the next question is this. Okay. I would not want my family to have to try to figure out what my wishes are if I became unable to make decisions for myself. So I can fill out what? It's 2 words. So what can you fill out? 2 words. If you know the answer, go ahead and give it to me. Just type it in the comments and then we can timestamp it and see who answered first, the correct answer, and then I'll get your book to you. But I want to share a little bit more information. Well, I just want to share some, this book right here, how this book right here can really get you to understand so much, and why everyone needs to have this book in their home. This is my goal. Make sure everyone has this book, Saving Your Future. And why do we name it Saving Your Future? You think about it. We're helping you to save your future by educating you, getting you to understand the importance of money and how your money works. Because everybody I know, and I know I do, I work very hard for my money. But how do I take part of that money that I'm working hard for and make that little bit of money work hard for me? And that's the key. You work hard for your money, but you take some of your money and you put it in, you put it in the right place so that it can work hard for you. Let the money work hard for you. And Warren Buffett said this, and I'm not sure I'm going to get it quote right, but if your money is not working for you while you're sleeping, then your money's not working hard for you. So while you're sleeping, your money should be working. You go to sleep, but you let that money continue to work for you. That's the key. So just to let you know what's in this book here, I'm going to read a few things out of here. Okay. According to surveys conducted by the Federal Reserve, the Consumer Finance Protection Bureau, and research firms in America, North Americans are facing serious financial challenges. So just think about this, what's happening in the United States. And this is basically pre-COVID. So this book was basically produced prior to the COVID. And since COVID, things has gotten worse. But just think about the picture in the United States. 40% of Americans struggle to pay their bills on time. Now you just think about 2020. If that was 40%, that right there has increased. And that's just not for America. That's global. That's around the world. So I'm pretty sure it's more than 40% now. It's probably 75% of Americans were struggling to pay their bills. The average American household carries about $16,000 credit card debt. And this is before COVID. So guess what? We know that number is higher. 44% say they could not cover an unexpected expense of $400. Now you just think about this. Something happens, you need $400 to cover it, and you don't have it because you have never been taught that you need to do something just as simple as this. Make sure you build yourself an emergency fund. So you was never told that, you was never taught that, so you don't have that extra fund setting aside to make sure if an unexpected expense comes in that you'll be able to cover it. And I'm going to say it's like this. It's all from lack of financial knowledge, because if you don't know it, there's no way you can do better. And I'm always saying this, if you have children and you're not teaching your children about finance, or if you don't know it, you make sure they get it some sort of way. Either go to our workshop classes, or get them, make sure they're going to some sort of classes at outside of school, because schools are not offering these workshop classes. Correction. The schools are not, public school system is not making sure that our young adults, when they get out of high school, that they are equipped with what they need in order to build a strong financial foundation. Most of the children that get, I ain't gonna say children because they're young adults, but most young adults, when they get out of high school, guess what? They graduate from high school and they don't know how to, a checkbook. They don't know how to write a check. And I was surprised that one of my nephews was just like that. Straight out of high school, didn't know how to write a check from a checkbook. Didn't know how to balance their budget in the checkbook. So our children are not coming out of high school with equipped what they need to make sure they can build a strong financial foundation. Because the first thing when you turn 18 years old, you think about it, you turn 18 years old, what's the first thing you see in your mailbox? When you turn 18, you're going to start seeing solicitation for credit cards. So you get this credit card, and what do? You're 18 years old. They're offering you $500. You say, whoa, wow, this is a lot of money. And you open that account, and before you know it, within a month's time or less, you're at $500 debt on the credit card. Now you're age 21. By the time you're 21, unfortunately, along with credit card debt, but also college debt, college tuition debt, Our young adults, by the time they're 21, they have what? And I'm serious, over $50,000 in debt, 21 years of age. And so, that's why I think that, what is the legal age for drinking alcohol? Is 21. Maybe that's why they made it a legal age of 21, because by the time you get 21, you have $50,000 debt. You need a drink. So just think about that. Our children not coming out of high school equipped what they need in order to make better financial decisions. So we want to remedy that by offering our workshop classes Monday through Friday, 2 p.m., 8 p.m., and 10 p.m. We also do it on Saturdays at 10:30. So we offer it. All you have to do is register at worldsystembuilder.com/WSB US and register for one of those classes. Get your whole family involved. Y'all should be having, have you have movie night, which y'all should be having financial movie nights where you're just registering your whole family to watch and get educated with these classes that we offer. And once you register and once you're going through all 4 classes, guess what you get? You're going to get a certificate of completion showing that you've completed those classes. One of the workshops that we offer, first of all, one is increased cash flow and debt management. So when you come into that class right there, you're going to know how do I increase my cash flow? That's a good question. How do I make more money? How do I manage my debt? How do I get out of debt faster? So you're going to come to classes, you're going to learn that. And also in the first workshop, most people find money that they've never known they've had before. And it's all because of prioritizing your budget. Basically, you prioritizing, where your money goes. And you're going to realize that, hey, I didn't need those shiny sneakers for $150 when I should have been investing in the sneaker company. Instead of buying $150 pair of shoes, I should take that $150 and invest in a company that makes it, and boom, I'm making good money. The second workshop, building a financial foundation and proper protection. So you want to learn how to build a strong financial foundation. There's steps to do that. Truly, there is steps to building a strong financial foundation. First thing you have to do, you have to make sure you're properly protected. And when we're talking protected, I'm talking about life insurance. I'm not just talking about any insurance. I'm talking about life insurance. And I'm going to tell you something right now. Last week, Friday, my pressure went up to 230 over 130. I was at stroke level. And I'm telling you what, I'm glad that I already had my insurance in place. Because, it's hard to get insurance if you're not healthy, or if you do get it, if you're not healthy, it's going to cost you more. So my pressure went up. Now I got my life insurance, but I'm going to tell you something what I don't have, and I've been trying to get it. Since I learned about it 12 years ago, long-term care. I can't get long-term care coverage because of what? My high blood pressure. So I got my husband covered with long-term care. So when he gets to the point where, he's not able to do 2 of the daily living activities, that maybe, someone has to come in and help me take care of him. Guess what I have? I have the funds to do that, to make sure that he's taken care of. And I don't have to worry about where am I going to find the funds, the extra funds to help take care of him while he's in the situation he's in. It's called income replacement, guys. Income replacement. Something happens to you. What kind of income replacement do you have? So life insurance is not just about death. Life insurance, you can utilize it while you're living, and you need to learn, what options you have with the life insurance policy that you have now. So with me having high blood pressure, yeah, I got my life insurance, thank goodness, when I did, but I'm not able to get that long-term care, and I really want that long-term care. There's 2 types of long-term care now. I was not even get the one which would be as a rider on my life insurance policy. but I could get what you call a standalone policy. Now, I prefer to get the one that's as a writer on my long-term on my life insurance policy compared to having one that's a standalone. Because a standalone, I have to put a large amount of money up front, like $60,000, to go ahead and buy my life insurance, my long-term care insurance. But the good thing about that is, if I take 60,000 and I purchase the long-term care, immediately that money almost doubles. So if I need it, I don't just have 60,000. I'll have maybe about 150,000 that I can utilize for my long-term care. So I want you guys to understand how long-term care works. What's your options? What types of long-term care is there? Standalone is also as a rider. So get to understand. Question time. All right, the next question is this. Very simple. Okay. Okay. If my total estate is over $1 million, I may be subject to what? It's two words. So if my total estate is over $1 million, I may be subject to what? It's two words. So I want who's ever out there listening, get those two words up for me, and let's see if you win your book, Saving Your Future, Basic Principles of a Financial Foundation. Now I'm going to share a few more pages, another page out of here. Now, okay, let's take a look at this here. There's something that's called a three-leg stool. Three-leg stool. As long as you have three legs on that stool, you can sit on it, right? What if you take one leg off? Can you sit on it again? Nope, you're going to fall. What if you take another leg off? Nope, you're going to fall. So I want you to think of your basic retirement, what we relied on for retirements. The past 40, 60 years, things change. We used to rely on what? These three things we rely on. Pension, which is company pensions, which companies basically don't offer pensions anymore. I'm very lucky. I do have a pension. So my company will pay me, the police department will pay me until I close my eyes. I will get a monthly paycheck. That's called a pension, defined benefits. So we relied on the pension, and then we also rely on Social Security. So by the time we get 65, we can get also, without pension, we'll have Social Security. And then personal savings. But guess what? Out of those three, pensions, take it out because it's not a guarantee with companies now. So you're left with two legs. You're already unstable. You can't stand up. And what's even worse, you do this. Social Security. Oops, take out the wrong one. Social Security. Social Security, take that out of the equation. Then what happens? You rely on your personal savings. And guess what? We can put that halfway because we're not saving enough. So our three-leg stool looks like this. Very crooked. We don't have that Social Security. It's not guaranteed anymore. You call Social Security yo-yo. So you're on your own. You're on your own when it comes to Social Security. And then guaranteed with pensions, most companies going with something called 401. And 401k plan, who's responsible for contributing to their plan and 401k plan? You, the employee. And guess what? Most people not going to contribute enough in their 401k plan to have enough to retire on. And there is a limit as to how much you can contribute to your 401k plan every year. And most people not reaching that limit. If it's 18,000, most people not putting in 18,000 a year within their 401k plan. Now, if you get a 401k plan, that's free money because some companies match to a certain percentage. If they match it, that's free money. That's free money. But also realize at the same time, when you're ready to retire 20, 30 years or 15 years down the line, that's 401k may not be enough. We have to rely on, we have to learn to save more. We have to start saving more because this right here, saving, is our number one, basically our number one saving your future. You have to learn how to save, but you also have to learn how to save where your money's going to grow. Where you're going to put your money makes a big difference on how it's growing. Okay, so the three-leg stool, pensions down, Social Security out of the way. You're left with you making sure you save enough. So, another information I want to share in here is understanding how money works. Okay, understanding how money works on page 7. This is a formula that the wealthy has been using for so many years. And it's a simple formula if you understand how it works. You have to start with money. You have, in order to make this work and understand how this works, you have to have money. Does not matter if it is a small sum every month that you're putting away. It could be $50, $100, $200, $300. You're putting it away every month. That money is going to have time to grow. So that's the next step. Or if you have a large lump sum that you want to start saving, but you have to give that money time to grow, which means you cannot be putting into this plan, into this formula. You put your money in, but next month you put in $300, but next week and next month you're taking out 150 of that. You can't do that. You have to just let that money stay and let it have time to grow. So that's a plus. Time is a plus with your money. Now you also have to understand the interest, how your money is growing, because the interest, as it grows, if it's on a variable account, it's going to go up, and there your money has a plus, it grows, or it may go down. There your money, you lost a little bit of your money, but you still let that money sit there. You don't move it. Now you have to also understand that inflation is going to affect your money. What I mean by inflation, you think about this, okay? With the interest rate going up and down, and your money growing, and then you may lose a little bit. But let's say that somebody says, I'll take my 50,000 and I'll just put it under the mattress. Okay, you put your money in the mattress, under the mattress, and you let it sit there for 30 years. 30 years later, what you got? 50,000. But really, you don't have 50,000 because cost of inflation has increased. So if you have 50,000, if you wanted to, say 30 years prior, you wanted to go out and buy something, and you didn't have to use all your 50,000, but by the time you want to buy that same thing, it's going to cost more. You probably need more than 50,000 to get what you want. So you have to realize you have to have your money in a place that's going to be growing with interest for you. You have to understand inflation is going to affect your money, which means that 3% increase of, price of things, the cost of things really increase by 3% annually. Now also, your money has to go through tax. You have to pay taxes on that money. IRS is going to hit you. But once your money has gone through this formula, you got your money, sits in there for time, it goes to the rate of return, you pay the inflation, realize inflation is going to hit it, and you pay your taxes out of that. What's left, this is your future. So let's say this is 30 years down the line. Whatever you have here, 30 years from now is going to determine what your wealth looks like. So remember, the wealthy has been using this for many years. This is how they know, how to basically make sure they save their money and put it in the right place. So, okay, time for another question. Okay, next question is, okay, if I own a business, I need a blank plan. If I have a partner in the business, and I need a blank. So if I own a business, I need a blank plan. And if I have a partner in the business, I need a what? We just went over that, so you should know it. Okay. All right. Now, to go back to this book here. Few things I want to talk about. We know the rate of return. Buy what you want, not what you need. Let's go back with buy what you want. Okay. On this page here, on page 8, it talks about buy only what you need. Okay. So when we talk about this page right here, spending money is a way of life for many people. Shopping becomes a habit. It can become an addiction. You know, for y'all people out there, I'm telling you, I just went to Amazon and I brought maybe about $300 worth of clothes that I thought I needed. And you know what? And I put on a credit card because my credit is back up with since I was in what you call bankruptcy. Now my credit is up and I got this credit card at Amazon. And I thought when those clothes came to me, you know, I sent it right back. I just went on and got my money back because I didn't need that at the time. So buy what you need. Spending is a habit, but guess what else can become a habit? Saving could be a habit as well. I have learned when I got my first job when I was 16, and I have always been a saver. So when I was 16, I opened up my very first savings account, and I'm going to tell you a little story. I had these old coins, and I didn't understand banks at the time, so I gave them these, and I know those coins was worth something because, I mean, it was real old. And me open up a savings account, I gave it to the president of the bank and told him, saying, hey, I'll open my savings account, but I want you to make sure that these coins are taken care of. See, I didn't know the difference that what I needed was, and he took my coins and he just put it into my savings account. He didn't realize that what I needed was a safe deposit box. So that was never explained to me. Safe deposit box, savings account, two different things. If you want to make sure that your rare coins are, you know, are protected or saved, you open up a saving deposit box. If you want to save your money, you open up a savings account. And see, I was not taught that. So what I'm telling you guys is this: understand money. Understand. You have to learn it from somewhere. If you're a parent and you can only teach what your children, you can only teach what you know. So if you know it, you can teach your children. If you don't know it, there's no way you can teach your children. So why not make sure that you go to worldsystembuilder.com/WSB-US and go ahead and register for our classes, 2 o'clock, 8 o'clock, 10 o'clock, and go ahead and learn. So you make sure your whole family understands how the, how money works. And y'all make that money work hard for you. We got maybe about 2 minutes left. I'm going to ask one more question, and then I'm going to close it out. I miss my partners, I'm telling you. All my important documents, trust, wills, agreements, insurance, debt, retirement, and investment accounts, and any CDs or annuities need to be kept together and in a what? So what is that question? Answer. All my important documents, trusts, wills, agreements, insurance, debt, retirement, and investment accounts, and any CDs or annuities need to be kept together and in a blank. Okay, that closes out for us today. Just want you guys to know that this has been Financial Sins, a all things relevant media platform. Y'all make sure that you share, let people know that this is on every Friday, 1 p.m. And also, it was a pleasure being here today. Looking forward to having my cohorts with me again next week. Until then, you guys, make sure somebody win one of these books. I was only able to give, I think, 5 questions out today. But looking forward to seeing who answered it correctly and getting your Saving Your Future book to you. Until then, you guys have a great day. See you next week, Friday at 1 p.m. All things relevant, Financial Sins. This is Florence Glover. Call me Mad Flo all day long. Making a difference for life and others. You guys have a great evening. Thank you.